Right, now I'm first going to read through requirement 1. We're going to complete requirement 1. Then I'm going to move on to requirement 2. Requirement 1. Prepare all the relevant journal entries, important cash transactions included in the accounting records of ChocoCoffee Ltd. to correctly account for the roasting machine purchased. And look at this, guys, and you need to read and the foreign currency creditor. Therefore, we need to look at the machine as well as the creditor. Prepare only the journal entries relevant to the following dates. Extremely important. Therefore, don't waste your time with the other journal entries. We only need to prepare the journal entries for 1 December 2010, 31 December 2010, and 30 June 2011. Your answer must comply with the requirements of International Financial Reporting Standards. Note, ignore all tax implications. No journal entry for depreciation is required. Therefore, do not waste your time. No abbreviations for general ledger accounts can be used. This is very important. You need to indicate that you know your general ledger accounts. Journal narrations are not required. Now, do you know what a journal narration is? This will be, for example, when we recognize, let's say, debit, our property, plant and equipment, our machine, credit, our creditor. Then the journal narration will be the explanation in terms of why you recognize that journal. Important, show the date of each journal entry, show all your calculations, round all amounts to your nearest rand. Right, now, I want to take this one step back. And I want you to ensure that you are comfortable and familiar with these principles. Number 1, if you look at a timeline, you will identify when you work through your learning units, we talk about initial and subsequent, measurement, and recognition. We also talk about subsequent, measurement, and recognition. Now, you will identify throughout the video that I am going to touch on this. What does this mean? Initial will be the date that you purchase that asset. This will be your day 1 when you purchase that asset or when you encounter into that transaction. We need to identify about how do we measure, how do we calculate the amount. Recognize, how do we journal this amount? What do we debit? What do we credit? In terms of subsequent, when you look at the right side, subsequent will be our year end. Therefore, in this question, our year end will be 31 December 20.10. And again, measurement, how do we calculate that asset or liability? Recognition, normally, guys, what do we debit? What do we credit? On the right side of your screen, exam technique. Now, if I could have, I would have yelled this out, but my voice won't allow me to do this. Exam technique is crucial. You need to plan. How are you going to attempt your question? You do not have to write this out, but you need to think about this. Now, when I look at this, it's a journal. Therefore, in terms of this journal, with all of the different variances or different information here, I want the timeline, because the timeline need to tell me when I need to recognize what. Then I'm going to make use of my timeline, and I will able to include my journal in accordance with my learning unit 6 principles. Important in terms of our timeline, remember only 1 December 2010, 31 December 2010, and 30 June 2011. Okay, now, warning, beep, 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 warning sign. You have to read through this. I've provided this page to you throughout the year on my UNISA. You have to read through this to be able to follow the following discussion. I'm not going to read through this, please. Right. In terms of our timeline, my plan of action, step 1, plan of action, we need to include a timeline. Now, let's have a look at our timeline. This is at the end of your question, explanation for roasting machine. On the right side of your screen, this is my timeline. Now, important, remember, 1 November 20.10. This is your order date. This is the date when they've placed the order. When you look at the explanation on the left side, guys, I assume this is a timeline, okay? But I want you to look at my timeline. Then on 1 December 20.10, this is when they've shipped the machine free on board. Therefore, in terms of our rule, because they've shipped this machine on 1 December, this is the date when ownership will pass. Therefore, this is the date when we will have to recognize our invoice, the asset. Now, if you think about ownership, if we are able to recognize ownership on this date, our journal entry will be to debit our machine and to credit our creditor. This is the recognition. Now, again, look at your timeline. Then on 31 December 20.10, this will be our year end. And then on 30 June 20.11, this will be our payment date of the creditor. Therefore, immediately your journal will be to debit your creditor, because we are going to pay the creditor, and credit our bank. Now, this will be our scenario when we do not have any. Sorry guys, my voice is it's actually starting to hurt a bit. Okay. So this will be our scenario when we do not have any IAS 21 foreign exchange gains or losses. Guys, I do expect you to know at least your journal entries, right? Now, if we take this one step further, we now need to add our IAS 21, our foreign exchange gains and losses rules. Now, on initial recognition, which will be 1 December 20.10, what will the value, the measurement be of our creditor and our machine? If we look at the information provided on 1 December, just get back to the scenario, 1 December 20.10, the value is 10 Rand 3 cents. Therefore, we need to use our 10 Rand and 3 cents. Therefore, the value, if you look at the journal entry provided to us on transaction date, will be to debit our machine, credit our accounts payable, creditors, and the 3,000 foreign currency times the 10 Rand 3 cents. In terms of a rule that you are able to study, is on transaction date, you need to use your spot rate on this date. Therefore, this will be the 3,000 times the 10 Rand 3 cents. Right, now we need to take this one step further. At year end, let me just identify the color for year end, orange. At year end, which is 31 December 20.10, IAS 21 tells us that we now need to measure this creditor that we have recognized at spot rate. Another rule, at spot rate. Therefore, we now need to remeasure our creditor at spot rate. What is spot rate? Again, refer back to our scenario. Spot rate will be 10 Rand 36. Therefore, if we now look at this, 10 Rand 36, include this here, guys. I'm going to make use of blue, 10 Rand 36. Right. We have recognized our creditor at 10 Rand 3 cents. But now we will have to pay. If we were to pay our creditor at year end, our creditor will be worth 10 Rand 36. Do you see that the creditor will have increased? Therefore, immediately at year end, which is 31 December, and you need to include your dates, please, we are able to identify if our creditor increase, our creditor will increase on the credit side. Therefore, this will be a creditor. How do we calculate the increase? If you look at the solution, our year-end journal, 31 December 20.10, it will be the 10 Rand 36 minus the 10 Rand and 3 cents. Remember, we've identified that there will be an increase in our creditor times the 3,000. Let me just make sure that you are comfortable with this principle. Please look at the right side of the screen for me. On 1 December 20.10, that creditor had a value of 30,090. Now, at year end, if we remeasure our creditor based on the spot rate at year end, the creditor will have a value of 31,080. Therefore, we will now have to pay more. If we pay more, there will be an increase of 990. Right, therefore, when you look at our journal, we will debit our foreign exchange difference, which is a loss in our profit and loss, and we will credit because our creditor will increase. Right, if we get back to our timeline on the right side of your screen, 30 June 2011, just want to identify the color I've used as pink. 30 June 20.11 is our payment date. We've identified our payment journal. But again, what does the standard tell us to do? We need to remeasure our creditor at spot rate. Look at this, guys. If you look at the top of our timeline, at spot rate, at spot rate, at spot rate. What do you need to remember? Spot rate, spot rate, spot rate. Right. Now, if you then look at our year end, we will have two journal entries. Number one, where we will have to remeasure our creditor at spot rate. And number two, our payment journal, which you need to know, guys, and understand. Right. Now, if we need to remeasure at spot rate, what is spot rate? Spot rate will be 10 Rand 29. Look at the right side of your screen, please. If we include this here, which will be the 10 Rand 29. Okay, now let's identify. Currently, our creditor, sorry, I actually want to look at the journals, right? Currently, our creditor is valued at 3108. Now, on payment date, we will have to pay the 3,000 times the 10 Rand 29. Therefore, if we look at those 3,000 times 10.29, this will be 30870. do you see that if you compare this to the previous balance of 3108 to 3870, that there will be a decrease? Do you see this, guys? Therefore, if there's a decrease in our creditor should be debited. Therefore, if you look at our journal on 30 June 20.11, where we first had to remeasure our creditor, journal number 1, therefore we debit our creditor a decrease, and we credit our foreign exchange difference gain in our profit and loss with a 210 decrease, because we now have to pay this 30,870. Therefore, if you look at all of our journal entries, we've credited our creditors with 30,090, credit our creditor with 990. If you add these two amounts, this is 31080, and now you need to deduct that 210. This is 30870. We pay the creditor, which is our step number 2 on settlement date. We pay our creditor, therefore we debit, we clear the account with a 30870, and we credit our bank decrease. Now, guys, I just want to make sure that you are familiar and comfortable with your debits and your credits. Again, this is your rules. You need to write this, and you need to know this and study this. If we look at an asset, this is a T account. This is your debit side, and this is your credit side. An asset will increase on the debit side, decrease on the credit side. A liability, debit side, credit side. Liability will increase on the credit, decrease on the debit side. Then we have our income. Our income will, credit, debit, will increase on the credit side, decrease on the debit side. Let's take this one step further. Our expense, debit, credit. Our expense will increase on the debit side, decrease on the credit side. And we still need to talk about our equity. Our equity will increase on the credit and decrease on the debit. Therefore, when you look at this at the top, we have our asset, liability, equity. This is our statement of financial position accounts, and at the bottom I have my profit and loss. Again, this is your rules. Then if you look at the explanation, remember, we did not have to recognize our depreciation, but if you look at our timeline, you should have been able to identify that there will be depreciation on your machine. Why? If you think about your initial recognition, remember, and your subsequent recognition and measurement. Subsequent, there will be depreciation on this asset. Okay, therefore subsequent, there should be depreciation on the asset. But, what did they indicate to us? That the asset is only available for use when? On 1 January 20.11. Therefore, we may only depreciate this asset from 1 January 20.11. Because for this month here of December, this asset was not yet available for use. Again, guys, I can't emphasize enough that you need to please know your rules.